Sure. I think if you look at the VIX over the last 6 months, it's been trading at a very elevated level, and I don't see any reason that that's going to change in the near term. There's forces that are pulling the market higher and pushing it lower. And if you look at the European equity market over the last several months, that's very much been a sideways journey. However, looking forward just a few months from now, we're going to have clarity on a lot of those areas of uncertainty that you've mentioned. So the U.S. presidential election, the Brexit trade negotiations, fiscal stimulus. So I think we just need to be patient and get through that period, and then we really focus on 2021. And the outlook for equities across the globe is pretty positive in terms of an environment in which we should see a strong economic recovery, strong earnings recovery, all in the context of low interest rates.
I'm curious as to how investors are using the VIX then to protect them against these key risk events. As you point out, that the fiscal stimulus, the US election, the second wave of infections, coronavirus, what we were seeing, and also Brexit. So what do you make of the positioning around VIX, whether it's unusual versus what we've seen previously in history?
I don't think it's unusual. I think it's just reflective of the fact that the biggest risk and source of drivers for the equity market and the economy going forward is the vaccine discovery and deployment. So, the Johnson & Johnson news overnight illustrates that we can't take that for granted. But I think if we look forward 6 months from now, or whatever the time frame is, hopefully we'll have that in place, and investors and consumers will really be looking forward to a return to normalcy. And so, the market is very much a forward-looking mechanism. And once we get more clarity on the vaccine, then the economy backdrop and the market backdrop will be much more positive, and hopefully at that point you'll see the volatility in the VIX come back a little bit.
Yeah, but Chris, is the market also wearing rose-tinted glasses at the moment as it looks ahead to next year? There are plenty of people who don't think we're going to see a workable vaccine until well into 2021 here. We've got incredibly low interest rates because of the economic circumstances we were in coming into COVID. We've got record levels of corporate debt, and we've still got very sluggish demand in key sectors of the economy. How is this a good story for equities for the early part of 2021?
Well, I think we'll learn more about this in the coming weeks as companies report Q3 results. Our discussions with management teams over the last 4 to 6 weeks really reflected much greater optimism than we heard from them with Q2 results 3 months ago. A lot of our discussions were with Japanese companies with exposure into China. And you mentioned earlier the export and import data from China today being very positive and very encouraging. And that's consistent with what we've been hearing from management teams. We've seen consumers in China spending, and importantly, we've seen them traveling within China. And that traveling was interesting because Chinese airlines that had been given payment holidays on aircraft leases had begun paying again. And so that is, an encouraging sign in terms of return to normalcy within the domestic Chinese market, which is so important for many companies, not least of which Japanese companies. We also saw strong construction equipment sales into China over the course of the quarter. So I think there are those nuggets out there that are something to look forward to. We'll hear from management teams and see what their outlooks are over the next few weeks as they're saying more to the market.